guys concerned, stressed out, intimidated, anxious, or uncertain? If you guys want to tell us how you're feeling in the chat. As a first-time home buyer, guess what? You're going to feel a lot of emotions, and you may be asking, will I get approved? Am I going to be able to afford my dream home? You know, like the one that you played with as a kid with Ken and Barbie. You may be stressed out. Maybe you didn't get the first house you wanted, or it's been a month and you still haven't found the perfect house. You may feel intimidated like David and Goliath in this crazy market, which is now turning from a seller's market to a buyer's market. The buyer's market means there are more buyers than sellers, which makes it easier to buy. And that's a really good time for buyers because you get a bigger selection. You can narrow everything down. Back 6 months ago when there was tons and tons of buyers, you know, you had to basically try to put in an offer for what you could get, and you couldn't be super picky about anything. So easier to buy, and I even get stressed out in these situations. I'll play that in a second. This is my amazing team. I'm Todd Poor with TD Realty. I've been in the real estate business for 15 years now. I do have a background in building homes. I also started a tiny home business in Midland for the oil field, and we only employed addicts, alcoholics, and people with felonies. And I myself, I'm over 6 years sober from alcohol. Because I have the background as a builder, I do a pre-inspection and make a video of the house the first time we go look at the house. That way you can, instead of getting under contract and then hiring an inspector, you know all the problems right up front, and I can give you an estimate about how much it's going to cost in remodeling. I have people to do all of those things. Nicole is my transaction coordinator that keeps my contracts in perfect order, so I can't make mistakes, and not very many agents have one of these. And the greatest part of it, say there's a deadline at 5 p.m. and it's 3 p.m. and they make deadlines for offers. You have to get it in there in 2 hours. I just send all the info to her and she sends everything back to you. You can sign everything on your phone, but we'll go over all the contracts before all this happens, and boom, send it in real quick. And yeah, she's incredible. This is my expert loan officer. He goes above and beyond for my buyers and myself. He saved a lot of deals for me. I've been through probably 6 different loan officers, and I stuck with Blake. Yeah, I don't get paid a dime for any of these deals we do, me and him working together. I just want the best deal on a loan for you. And honestly, you don't pay me a dime either. The buyer doesn't pay me, the seller pays. And let's go. Yeah, if you have questions, please utilize the chat. We'll answer questions at halftime and afterwards. I put it in the chat too. Book a one-on-one call with toddpoorrealty.com/book. You can talk to me and Blake, and we can get everything figured out for you. Here's just a quick what am I losing my mind? Here's a quick review from Savage Traveler. He talks about me paying a lot of attention, looking over the house, and Blake doing an awesome job. And then this is Kristen. She's an awesome person. We've become really close with me and Blake have been really close with this family. They just actually cooked me dinner. What was it? About a month ago. And She's awesome. She's put reviews everywhere. What are the steps to home ownership? Be sure to schedule a mortgage planning session with our senior loan officer, Blake. You can book it at the exact same link. And then you get it pre-approved. And I can't stop thinking about you, Blake. So I'm going to turn it over to you.
Fair enough. Hey, I appreciate that. Glad I've made an impression, and thank you very much for the kind words. Like Todd said, step number one, book that phone call with him, toddpoorrealty.com/book. He will talk to you, find out your goals, find out what your needs are, and then he will send you over to me. I will give you a call so we can work on the next step, which is getting pre-approved. So once we're pre-approved, or during the pre-approval process, I should say, we do look into first-time home buyer qualification and make sure that those down payment assistance programs are there for you to utilize. If the state's going to give you money to buy a home, we might as well use it. So now we're pre-approved, and you and Todd get to go hunt for a house, and you get to find that perfect home. This is really where the fun begins, because you get to go and see if you like this bathroom or that bathroom, or do you want split bedrooms or what. So that's where the fun begins. And once you find that home, you submit the offer, and Todd's going to negotiate some terms for you on that. Once the offer is accepted and the terms are accepted, you are under contract. So this is where the real fun begins. So you get under contract, and everybody signs, and then I get a copy of the contract, and we structure the loan to that house and the way you need it to get it done. It usually takes about 30 days. We can get it done a little bit less, depending on the situation, but it takes about 30 days. And then we finalize that financing, and we get clear to close. And once we get clear to close, you go and you sign a bunch of papers, and you get the keys. And, we take a picture at the title company with Todd and myself, and you guys get to move in, and then you're enjoying the life, making that great investment. But mistake number one is ignoring the first-time home buyer incentive programs. So what is the first-time home buyer grant? Well, it is specific to your region, and in that, it is dependent on your income. So each county has a median income, an average income, and they set specific guidelines, or they set a ceiling on that. So if you make above a certain amount, you are not eligible for it. So we'll definitely look into that. And it is county specific. So Dallas County, the median income is higher than, say, like Jacksboro or Wise County. So the first time homebuyer grant is a little bit different with those guidelines. Now it does come in the form of a forgivable second mortgage. What that means is it's basically another loan that's given to you. Here's your main mortgage, and they put that forgivable second right behind it. And it's forgivable because you stay in the home 3 years, and then it's forgiven. You don't owe that money back, but you have to stay in it 3 years, and you can't refinance out of that for 3 years. If you do either of those, you do have to pay it back. And these are the down payment assistance programs. So here's an example. Anita wants to buy a home, and I got her approved on an FHA loan. The purchase of the new home is $300,000. Now with FHA, the minimum down payment is 3.5%. So for Anita, that comes out to $10,500. With FHA, there is upfront mortgage insurance cost, and that's 1.75% added to the loan after the down payment, which makes the total loan amount $294,566. Well, the incentive I got her approved for is 5% of the total loan amount. Now that is $14,728. So now with that, she's got her total down payment covered by the incentive with $4,228 left for closing costs. That could cover title, that could cover escrows, that could cover origination fees, all of that. So very, very helpful with that.
Hey, Blake,
Yes.
you say upfront mortgage insurance, 1.75%. So usually I guess that would be out of pocket, right? But you can put it into the loan.
Great. Actually, that's a great question, Todd. You do have a choice. You can pay that out of pocket, or we can roll that upfront mortgage insurance cost into the loan. Now, that is when it comes to purchasing a house, that is the only closing cost that we roll into the loan. Everything else does need to be paid at the closing table. But yeah, that's actually a really good question. I get that a lot.
Hey, do you want to explain closing costs real quick?
Sure. Closing costs, real simple. It's down payment, or your closing costs are your title fees, your escrow fees, and your origination fees. So origination is like processing and underwriting. And if you're buying down any sort of like if you're buying at points on your interest rate, your escrow fees are your taxes and insurance. Those do go into escrow. And then title fees are, you have lenders, you have an owners, and then you've got some more title fees in there. Like there's an online fee, a transfer fee, and stuff like that, endorsements. So those are the three main closing costs. Now you take your closing cost and you add your down payment to it, and you've got your cash to close. So those are just some terms to think of. So getting back to the presentation, there are four types of mortgages. Conventional, which is Fannie Mae and Freddie Mac, and I'm sure you guys have heard of those. Those are government-backed entities that set the guidelines for conventional loans. So conventional is really great, especially for investors. We usually go that route and look into that for them. Number two is FHA. Now, it's a government-insured loan. So there is an upfront fee, the mortgage insurance, that the government does charge for that. It's a great loan. And we'll get a little bit more into that one here in a minute. Number three is the USDA. Now, this is a government insured loan. It is 0% down, but there is an upfront fee for this loan. And another thing on this, there are more guidelines that go into this. It is area specific. And again, there are loan limits and there are income limits on this loan, but it's a great loan. It's for rural areas. It's to help rural areas grow. And number four, my personal favorite, is the VA loan. It's only for qualified veterans and active duty military. Do we have any veterans with us tonight? Well, if we do, thank you for your service. This is a great deal. Again, 0% down, and they've raised some guidelines. So Sergio Ortega, very nice, very nice. So,
yeah. Oh, sorry. Yeah, I was going to say, I appreciate you fighting for us.
yeah, absolutely, absolutely. The VA is a great deal, and the veterans deserve it. Absolutely deserve it. Now, keep in mind with these four different types of loans, they may vary per lender requirements, which means one bank might want like a certain document that another bank doesn't. They might have DTI limits and different things like that. But these are the four main types of loans. And speaking of loan requirements, each one of those four main loan programs will ask for this. We are going to need a driver's license or identification card along with your social security card. We are going to need a residential address for all residential addresses for the past 2 years. We will we will need to verify income and name and address of your employer for the past 2 years. Need that 2 years history. We will need the most current 2 months bank statement, pay stubs and bank statements from which the earnest money or in cash to close will come from. We need to know where that money's coming from. And again, for the income verification, we do need 2 years worth of W-2s. And then for our self-employed, we do need copies of your most recent 2 years tax returns. That is, since you're self-employed, you don't have W-2s. So that is how we calculate your income. Any additional income like child support payments, Social Security, alimony, retirement, stuff like that. We do want to factor all that in. We don't always need that, but we do want to factor that in. And then a list of any assets you might have, like rental properties, any sort, anything that you're getting money in and has a monthly payment on there. So go ahead.
Oh, I was just going to kind of clear something up. So the slide before, or right here. So I just had something happen like this week. So my client wanted to purchase a house that was $200,000, and her cash to close, her down payment and title and all of her different closing costs was $18,000 because she was paying for a lot of things that she kind of didn't have to pay for. And she didn't want to pay that whole $18,000. So instead of offering $190 for the property, we offered $200,000 with $10,000 for seller concessions. So those $10,000, so you're paying $200,000, but that $10,000 is going to subtract from that $18,000. So when it comes time for her to close, it was only $8,000. Well, if you have extra money left over, you can buy down your interest rate. You can buy down your interest rate to 2% for the first year, 1% for the second year. There's a lot of cool things you can do with that. And that's just kind of what so I'll go over the rates and things like that for NACA and stuff later. Sorry to butt in.
No. That's a really good point. And we'll talk about that with the FHA loan and kind of what the guidelines are with that. Now, an FHA loan provides mortgage insurance on loans made by FHA approved lenders throughout the USA, like myself. Now, how do the first-time homebuyer programs work? Well, Fannie Mae and Freddie Mac, they have a Home Ready and Home Possible program, and for first-time home buyers, and that decreases the down payment. And with FHA, I usually use TSHAC in tandem with FHA. That's the Texas State Affordable Housing Commission, and they've got some really good programs there. Now, the benefits of an FHA. It's a low down payment of 3.5% with a credit score of 580. Now, with credit scores as low as 500, we can use a credit score as low as 500 with 10% down. Now, keep in mind, these are rock bottom credit scores. The lower the credit score, the higher your interest rate is going to be. So the more your loan is going to cost. We want to get your credit score as high as possible before we get you into contract. I can help with that. I always take a look at, when I'm reviewing credit, I always take a look at what we can do to make it, to boost that score almost immediately. See if there's anything we can do, because I'm not in the business of spending your money. I'm in the business of helping you create wealth. And if there's anything that we need to go further than that, we do have a credit repair specialist that can absolutely help you out with that. But keep in mind, with this 580 and 500, those are rock bottom scores. We can do it. We can get it done, but it's going to cost you in the long run. Another benefit of FHA is easy refinancing with the Streamline. And there are low mortgage rates. FHA rates are typically lower than than the conventional. Now they do have higher DTI ratios that are accepted. Who knows what DTI is? Anybody? I know you do, Todd. Debt to income. Stacy nailed it. It is debt to income. And that is a ratio that we get. What we do is we take all your monthly payments, your car, your credit card, your student loans, everything that's revolving. We don't use phone bills or electric bills or water bills or anything like that. But all your revolving debt payments divided by your monthly income, and it gives us a ratio. How do student loans affect rates? I will definitely answer that one because that's a big question. So I will answer that one when we get halfway. So higher DTI ratios, and with FHA it is 55%. So that's good. Now you can choose between a 15 or 30-year fixed rate or adjustable rate term. As of right now, we are only doing fixed rates. Reason being, we're not in an adjustable rate market. If rates were in like the 12, 13, 14 range, we would look into adjustable rates, but we're not there. So we get everybody a fixed rate for now. The down payment assistance programs and grants are accepted. Like I said, I use T-Shack with this. It's great. And here's what Todd was talking about. The seller can pay closing costs up to 6%. That is the guideline. So on the property that Todd was speaking about, the $200,000 property, the seller can pay up to $12,000 in seller concessions. So if his buyer was coming to the table with $8,000 and they used $10,000, that's her $18,000. Well, she would have $2,000 left over. Let's buy down the rate as much as we can. And that is situation specific. So I can't quote you exactly how much that rate would come down, but you know, the more you can get it down, the better, right? Saves you money in the long run. So a conventional loan. A conventional loan is a home buyer's loan that is not offered or secured by a government entity. It is available through a guaranteed by a private lender or the two government-sponsored enterprises, Fannie Mae or Freddie Mac. And I am that private lender for you. So here's a comparison between FHA and conventional. So minimum down payment for the minimum down payment for FHA is 3.5%, and with the Home Ready and Home Possible with conventional, it is 3%. Minimum credit score of 580 on FHA, and conventional it is 620. Generally, we like to have people in the 640 range. That is when we get the most affordable loans. So we generally try and shoot for that. We can get it done with these rates, absolutely. But most affordable range is the 640. Max DTI is 55% for the FHA and 46% for the conventional. So great news for everybody. The loan limits for 2023 have gone up. Both FHA and conventional have gone up. So FHA, it is $427,030, and for conventional, it is $726,200. Anything above that is considered a jumbo loan, and there are different guidelines for that. Now, income limit. The FHA and the government and Fannie Mae, Freddie Mac, they don't care how much you make. The more you make, the better. There's no limit on that. These limits are from Dallas County, and they are for the down payment assistance programs. I got this right off of tshack.org, and so you can get on there and look this up yourself. For FHA with the down payment assistance, the income limit is $97,400, and the income limit for conventional with DPA is $76,480. So the minimum out-of-pocket contribution for FHA is 3.5%. It is that down payment, and that can be gift funds, grants, or forgivable second mortgage. For a conventional, it is 3% and can also be a gift funds, grants, or forgivable second mortgage. And we'll get into the gift funds on this next slide. What you can and can't use for down payment and closing costs. Number one, a lot of people use their checking and savings account, and we do ask for the bank statements for that. We need to know where the money is coming from and where it's going. And that's federal law. We have to know. It's per the Patriot Act. When that was signed, they put this in there so that we know people aren't laundering money through real estate or funding terrorism. Number two is 401k and retirement accounts. Now, with these, there are terms of withdrawal. Sometimes when you pull a certain amount out, you will have to pay taxes on it. Or you can only pull so much out, or we can only use so much of that amount for reserves. And it's different with different retirement accounts. Gift funds from family members. We will be asking for financial statements from the donor of the gift funds, but they are acceptable. Your mom, dad, brother, sister, aunt, uncle, cousin can all help you out with the down payment. And, when you're getting into this process, make sure they all know. Make sure they all know that you are looking at homes. You are, and you might need their help. A lot of times they're willing to help. Sometimes they can, sometimes they can't, but it's worth having that conversation. You can also use stocks, bonds, or cash. We will need financial statements for that. Now, on the cash, it's not cold hard cash. You can't come in with a bunch of Benjamins, in a duffel bag and throw them on the table and say, here's my cash to close. That's not how that works. We do need to know where the money comes from. So we do ask for a cashier's check. We cannot use money orders because you cannot trace that money. You could go to Western Union and get a bunch of money orders with that bag of cash. So we do need to trace that, and does need to be a cashier's check.
Hey guys, I was just going to remind you to use the chat, click on the chat icon and ask us any questions that you want. And you can also see what people are asking and what's going on exactly. And then you can go to toddpoorrealty.com/book and book a one-on-one call or Zoom or in-person meeting with us, with Blake or myself. And that's it.
Yes. Lastly, things you can't use for closing costs. You can't go get a loan from your personal bank for closing costs. That will affect your credit. And you can't use a credit card with that. You can't use a loan or credit to make that initial investment into this. And you can't use undocumented cash. Again, you can't show up with a duffel bag full of hundreds and say this is good to go. So this is the buyer's eligibility based off the underwriter review. Who knows what an underwriter is? This is usually a really good question. Some people do, some people don't. So an underwriter, I'll just explain it real quick. An underwriter is the person who reviews the loan after I get everything structured and get all the documents and everything go, almost a loan writer, who I get everything structured, all the documents together in a nice, neat little package, and I hand it off to the underwriter. Now, what they're going to do is they're going to make sure that we're meeting all the guidelines that that are set based on the loan program. And they might ask for additional documents for, maybe there's a job gap, maybe you're moving here because of a new job, something like that. And we just need to document almost everything. So they'll ask for that. Now, what they look for in the loan is your ability to repay the loan. And in doing that, they look at the employment verification, your total monthly debts, your total income, and the proposed monthly payment. And the income, the debts, and the proposed monthly payment all factor into that DTI that we were looking at, that we were talking about earlier. Number two is your willingness to repay the loan. They are going to look at their credit report, the payment history of past loans, your rent, your bills, and what's the use for the property? Are you moving into the property because you got that new job? Are you buying the property to rent out? Are you moving mom and dad next door? Are you buying it next to your kid's college? All these things are factored in and into the situation. If you're moving into the house, you're more likely to pay that loan and pay that mortgage every single month because everybody needs a place to live. Number 3 is the collateral. Is the property eligible for a loan? And we look at the appraisal for that because that will determine the value. If the appraisal comes under, we can, rebuke it and see if we can get that value up. We're really good with our appraisers and our inspectors on that. All right, Q&A. Let's see what we got.
Oh, I would like a link to review later. So the recording of this webinar will probably be ready tomorrow. Just text me or book a call and I'll send you the link. I'm going to upload it to YouTube so it'll be easy to access. Are there any first-time homebuyer programs that offer lower interest rates other than NACA that will not require PMI? That's you.
So PMI is dependent on the loan program. The way to get around PMI is putting 20% down on a conventional loan. And the programs won't give you that much money to put down as a down payment. Because if at that point in time, you're getting into like investment property. The thing about conventional is once you pay down to that 20%, once you own 20% of that property, the PMI drops off. So we do look into conventional with all of the buyers just to make sure that they can qualify for the conventional. If not, we'll go FHA. But as far as lower interest rates, the down payment assistance programs do tell us what interest rates to use, and they are dependent on what the market is doing. So if the market and if the interest rates in the market go up, so do the first-time home buyer programs. They go up with that. If the market comes down, then the interest rates come down. Fortunately, recently we've seen interest rates come down, so the down payment assistance programs interest rates have come down, and they are offering more and more as the rates come down on that. Other than NACA, Todd, that's you know more about NACA in those programs than I do.
Oh yeah, I mean, I can cover that at the very end. That's part of the presentation, but I did just get a message directly sent to me. How does credit card debt affect purchasing a home or being able to get approved for a loan? Does medical debt also affect it?
So we see the credit card debt and the medical debt on your credit report, and it depends on your monthly payment. It's not how much you owe, it's how much you pay each month on that. With credit cards, the less you owe, the less you have to pay each month. So that all factors into the debt to income ratio, and which leads into the next question too. It's the same thing with student loans. So a lot of student loans now are in deferment. And with that, there are certain guidelines on how much I have to use as a monthly payment for that. I can't just use zero as a monthly payment for that. It has to be factored in for that. There are income-based repayment programs that are really good, and some people have gotten ahead on their student loans with that. So definitely, if you have student loans, look into that. Definitely look into that. But credit card debt, medical debt usually doesn't come with a monthly payment. unless you're on a payment program. And if that's the case, we do have to factor in the monthly payment on that. A lot of times with medical, we see that go into collections and disputes, and collections and disputes affect your credit score. So keep that in mind. You definitely want to pay that off so your credit score isn't coming down. Do you all work with Divvy Homes? More like rent to own. That's Todd. I think Todd, yeah, you're partnered with Divvy. You answered that one. Have you had any luck on new builds in which they are paying seller concessions? So we're actually going to cover that in one of these slides coming up, but real quick, with the seller concessions on new builds, you got to be careful with those. They're throwing a lot out there right now, and sometimes they're good, sometimes they're bad. If builders always want you to get approved with their lender. They want to make sure that you are approved. You're not just creating, the commitment letter by yourself and handing it to them. They want to make sure that you are approved. And with that, they will offer concessions, and there are some programs. And I do have some programs to help out with new builds as well. So keep that in mind. So, yeah, but we'll get a little bit more into that on one of these next slides. Let's see. I haven't looked into it. We have been in our home for 2 years and thinking about the buyback. I guess that's Divvy. Was that the Divvy question?
If you have any questions about Divvy, just let me know. I know pretty much everything about it. On the seller concessions, I'll talk about it a little bit here later, but you always want to have a realtor representing you because, well, first of all, it's free. If you don't use a realtor, they're not going to change the price at all. If you do use a realtor, there's a good chance that I can negotiate a better price. In the contracts or what you're going to need to be worried about, making sure you read all the contracts and understand them, because you can get yourself in a bad situation. What I would say about using your bank, trying to use builders, it's always good to get aggressive when you're looking for a loan. If you go straight to them, save all your paperwork in your computer, all the paperwork you need, and go give it to Blake, or he'll give you an application to fill out and see if he can beat that. Then you have two different looks at it. And yeah, I would always, if you're with a bank or anything like that, always go check with a lender also. And one small fraction of a percent, or there's a lot of small things that can change to cost you tens of thousands of dollars. So we'll go over some of that stuff soon. If you have any questions about Divvy, what else do we have?
I think that was it. Yeah, if you got questions about Divvy, book that call. Let Todd know your specific situation, and he can get a little bit more in depth as to if that'd be a good place for you to go or not. Just book that call. I think that'd be the best route.
Definitely.
Mistake number 2, not getting a pre-approval. So there are 3 pillars of a mortgage approval, and it's credit, income, and down payment. All these are factored in. Your credit score is basically how much of a risk it is for a bank to give you, $250,000 to go buy a home. Your income is your ability to repay it, and then your down payment is how much skin in the game do you have. Banks like to know that you're putting money down for that you're serious about it. So loan pre-qualification helps you determine how much you can afford to spend on a home based on the 3 factors: your credit, your credit score, and what the report says about your total debts. How much are you paying out each month? How long have you been paying on credit cards or your auto loan, or how much how much time is left on your auto loan, stuff like that. Your income is, of course, your ability to repay the loan. And that's based on your employment history and the income calculation, which I will do for you. And in employment history with that is, we want to see 2 years of stable work history. If we have 2 years of stable work history, the banks say, okay, this person's reliable. They're going to keep a job to pay us back. And then your assets, money used on your down payment or closing cost. Where's that coming from? The bank statements, your retirement, is it gift funds, stuff like that. Now, pre-qualification can help you determine what house you qualify for. You don't want to get under contract and put option and earnest money down on a $400,000 home and then not qualify for that and only qualify for a $350,000 home. Well, now you're out option money and you might be out earnest money at the same point in time. So to save you money up front, let's go ahead and get you pre-qualified. It does increase your bargaining power when negotiating with the seller. Once I get you pre-qualified, I get you a certificate. We call it a commitment letter, and it explains exactly how much you are qualified for, what address. It's got my pretty face on there, and it has a checklist of things that I look for in your pre-approval process, and it lets the seller know, yes, we've checked all the necessary boxes. So this can also estimate your monthly payment and total investment. And that's really good to know, because if you're wanting to stay within a certain range on your monthly payment, say you don't want to pay over $2,500, say that's it. Well, that's going to change the price range of what houses you're going to look at. Again, a $400,000 home, your payment might be $2,750, $2,800, maybe even $3,000, depending on where the home is and the different things that go into that home. And last but not least, probably one of the most important is it helps me identify which loan product will fulfill your needs. Do we need to go with an FHA? Do we need to go with a conventional? Do we need to get creative because you're self-employed and figure out a different loan program to get you in there? Or are we going to use an FHA or a USDA?
Yeah, I have it happen all the time. Someone will call me, I want to go look at this house. And my first question most of the time is, okay, are you pre-approved for a loan? What's your plan on loans and things like that? And sometimes, yeah, I'm pre-approved for a loan. And then we go look at the house, they fall in love with it. I say, okay, who's your lender? Send me the pre-qualification letter so we can put in an offer. Oh, well, it's my bank for the last 30 years. I'm sure they're going to give me a loan. It's like, you haven't started the process at all. You just told me you're pre-qualified. And people think they're just looking sometimes, and they'll worry about pre-qualifying later. And it just doesn't work like that, especially if you fall in love and you say this is the house. It could be off the market in 1 or 2 days. If you use a bank, they're 9 to or 8 to 5 Monday through Friday. So if it's on the weekend, you're in bad shape. That's another thing about me and Blake. I work 7 a.m. till 10 p.m. every day, and so does he. We've been up past midnight sometimes helping people. But it's still going to take a day or two at least to get it pre-approved.
Yeah, absolutely. Sun up to sundown, even into the wee hours of the morning. So loan pre-qualification tips for a simple loan approval, some do's and don'ts. Number one, call us if you have any questions whatsoever. If you're worried about what school district the home is in, if you're worried about a monthly payment on a certain property, whatever it is, whatever question you have, please call us. We are the professionals. We will answer this ASAP. And like Todd said, we're always working. We might be out at Cowboys Red River two-stepping, but we'll feel our phone in a pocket. We'll pull it out. And we'll answer it, as soon as we can. Do continue living at your current residence. Do not break a lease and start packing everything up if you're not in contract and if you've not closed on another home. I've had some people do that and they were homeless for a couple months. Please continue living at your current residence and continue to pay your mortgage or rent. Last thing we need are those late payments coming and biting us in the butt prior to closing and killing the deal. And continue to use your credit as normal. Make those payments. Don't overspend. Keep working at your current employer. If you are not moving for a job, it is best that you keep working at your current employer. If you are planning on transitioning jobs through this process, please inform me of that. We can work around that, but it's a lot easier and a lot better for you if we just stay at that same employer. Keep the same insurance company. They know exactly what you like. They know your budget. They know what you need. So stick with them. If you need a new insurance company, you want to shop around, I've got a great insurance agent. His name's Gavin. I can introduce you to him, and he can look and find you the best deal out there and see if he can beat what you already have. Stay current on all existing accounts. Do not fall behind on credit cards. Do not fall behind on anything. Again, make all your same payments and expect requests for additional documentation through the process. So if you are transitioning jobs, we will want to see the offer letter. If there's a job gap in there, maybe there's 3 weeks to, let's say, 2 months where you were transitioning jobs prior to this, and we need a letter of explanation for that. The underwriter will ask for that. So do not make any large purchases. If you do that, of course, if you put it on a credit card, that monthly payment goes up. If you buy a fridge and you got to pay it off, well, now we have to add that payment into your DTI. So do not make any large purchases. I know that Porsche is going to look great in front of this brand new home, but let's wait and let's get the home. Let's get you moved in and settled in. And then, maybe that's a Christmas present or something. Do not change bank accounts or make any large cash deposits. When we make large cash deposits, we have to source those funds. We have to make a paper trail as to where they come from. Again, that's the Patriot Act. They want to make sure no one's laundering money through real estate. Now, if you change accounts, if you're moving money from one account to the other, one of the accounts to the other, again, we're going to have to paper trail that. We got to figure out what's going on and where it is. So don't transfer balances either. Don't change your bank account. Don't transfer balances. Once we get you pre-approved, let's leave that chunk of money right there, and that's what we're using until we are closed. Don't close any credit card accounts. We need to keep your credit intact the way it is when you're pre-approved. Don't consolidate your debt into one credit card. That credit card might have a higher interest rate, or during the process, that interest rate might go up, which makes your monthly payment go up, which means you might not be approved for that house anymore because the DTI went up. Do not apply for new credit or take out a new loan or be a cosigner on a loan. Again, that will hit your credit. Any inquiries do pop up and they start to raise questions and red flags. We need to know what's going on at that point in time. And really, whether you are pre-qualified or getting pre-qualified or anything, you should never max out or overcharge on your credit card accounts. It does take a long time to get back from that. So do not ever do that. Mistake number 3, using your bank. Todd talked about this a little bit. Bank penalties are expensive. Definitely keep that in mind.
Yeah,
Most
sorry.
yeah, most banks will charge an origination or discount on points. That the way the market is, that's kind of the standard now. We are getting back to where we have rates that do not cost you out of pocket, but a lot of times your personal bank will charge you that. And in large banks, you're just a number. You're just one of thousands of people. If you go to Chase, when you go to Chase and you're like, hey, I want a loan, they're gonna send you the generic, this is what you're approved for, you're gonna go out and shop. You might not ever talk to that person again. You're just a number going through a system. Through this process, you've got my phone number, you've got Todd's phone number. You can call us at any point in time and we can work with you. Larger banks do typically have stricter guidelines on just the normal programs, and they might not cater to your specific situation. I do have a great relationship with our underwriters. So when they have questions or they like, hey, this isn't going to work because A, B, and C, I can say, well, Miss Jane, my borrower, she's a single mother. She's got 3 kids. She's trying to get into this home. I know this is what it looks like, but if you look at the history of what happened, let's make this happen. And we do take specific situations into consideration to get you in that home. In large banks, they may not offer the down payment assistance programs. And that's kind of big because it kind of shows you they don't want to go the extra mile for that. They don't want to take that extra step to help you get into that home.
Yeah, I was going to say, yeah, banks don't have to disclose what they make on your loan. You may end up paying more than you need to if you don't shop aggressively. If you're using your bank, I would highly recommend to save all of your forms and check with Blake and see what he can do for you. 9 out of the 10 times, he's probably going to be able to beat it. It's a little extra work, but it's extra work that could save you tons of money. And they are.
Go ahead.
Oh, they are stricter, especially if you have had credit problems or lower credit. Some of them don't work with first-time home buyer grants either. So just make sure you check with them. If you've been there for 30 years with an account or you just walked in the door, they're going to give you the same deal that the computer says. And communication is a huge part of real estate. You're gonna talk to a different person every time you call about the loan, or it can be a pain working with banks. Are we on pink? Okay.
Yeah.
Yeah.
Moving on to mistake number 4, buying directly from a builder. The truth about buying straight from a builder, the closing cost assistance, which we had a question about this, can be bait for higher interest rates. A lot of times, builders put these incentives out there, like, hey, we're going to give you 8, 10, 15,000 towards closing costs, but they put that in other places, and there's some hidden fees here and there. So you definitely want to be careful with that. If you think you're saving money, first of all, no one gives money away for free. That's not how that works. They're not going to give you $15,000 for free. There's always a cost involved in that. And number 2 is a realtor works for you and a sales agent works for the builder. One thing to keep in mind about Todd and myself, speaking of the realtor, is we don't get paid until you are in the home that you want. We don't get paid until after you close. That's not, we don't get paid anything. You don't pay us anything until that happens. And so it's our job, and we're totally invested in you getting in that home. It's our job to get you in the home that you like. A sales agent works for the builder. It's a sales agent's job to put someone in that specific home. It's not whether that's you or the next person. They're trying to put people in that home. We are trying to put you in the home that you choose. So that's definitely something to keep in mind.
Yeah,
You know,
oh, I just put in the chat again, book a one-on-one short call, toddpoorrealty.com/book. Please utilize the chat. We're going to answer your questions here in a little bit, but ask away. Getting back to buying from a builder, a realtor representing your interests will help make sure you're aware of what's included in the base price and what's extra, like granite countertops, this and that could be added into the extra costs, but you could see a difference of like $50,000 or $100,000. There's a lot of those things to look at. The quality of construction, I have a background in building, so you definitely want to go in and make sure when they're framing it, when they're doing all the different things, that they're doing a good job. How familiar are you with the builder, and what's their reputation? What is the quality of their construction? The big thing is the contract. How familiar are you with the real estate contract? I mean, do you know what to look for to make sure you're receiving all the benefits you're supposed to receive? Are you aware of any hidden fees or community fees? A real estate agent is an expert in the industry who is there to provide guidance throughout a real estate transaction. When you register at the very beginning, tell them you have a realtor. They'll ask you your realtor's name. If you want to make sure you have someone looking out for your best interest, tell the builder on your very first visit you're already working with an agent. The commission's not going to change at all. It's not going to change at all if you don't use a realtor, but you always want them to have your back. And back to you, Blake.
Yeah, like he said, it's huge having a realtor on your side. It really is. I've had to work with the sales agents, and with them, it's specifically one way. It's right here. This is the way it's going to be, regardless, or you're not getting in the home. And unfortunately, everyone's situation is specific to them, and it's different. And sometimes, we gotta move the box out. We gotta move it this way and that. Fortunately, with the way the market is, the way things have been going, the builders are being a little bit more lenient, but still, the sales agent works for the builder, not you.
Okay, on to skipping a home inspection. Thank you, Blake. Cost of skipping a home inspection. Well, I don't think you'd want a home inspection on this house. I'm not sure what you would do to fix that, but it wouldn't be fun. Yeah, you can purchase a house unaware of deal breakers. You can lose your negotiating power. A big part of negotiating power is when you purchase a house, you have an option period. Say it's 5 or 7 days. That time is your option to back out of the contract and get your earnest money back. Earnest money is kind of like the good faith, telling people you're serious that you put down at the very beginning. If there's a lot of problems and like problems all over the place, you can ask them to fix them, or you can ask for money back and negotiate the price again and lower the price. It's the same thing with a lot of builders. Well, it's a brand new home and we've already had inspections and this and that. You still want to hire an inspector. A lot of deals are as is. We're not going to make any repairs. So there's no reason for you to hire an inspector. Well, you still want to get an estimate of future repair costs. You can risk inheriting non-structural safety issues such as mold, radon, and carbon monoxide. and you're oblivious to illegal code additions. So if you turn your garage into another room, or you enclose your back porch and turn that into another room, you have to have a permit from the city. If you don't, that's against code. You can actually, even if you just bought the house and didn't know, they can still fine you for that, because it's going to show up in the survey. Oh, this house was 1,600 square feet. Why is it now 1,800 square feet? They don't have any kind of permit for adding that extra 200 square feet. So yeah, get an inspection. Here we go. Choosing the wrong realtor. I can't emphasize enough how much experience and communication is key. Whether you're looking to buy or sell the property, it's important to have the right real estate agent working for you. Your top priority is to choose someone who you're comfortable with, and at the same time has the right credentials and experience. Ultimately, you need to find someone you can trust. So what are the things you should look for? Areas of expertise are a big one. There are a lot of really good realtors around, and it's not hard to find a list of good realtors who have great credentials, but you need to know their expertise. Like my expertise is first-time home buyers. The starting point is establishing what kind of buyer you are. For example, are you an investor, a home buyer, selling an estate? Know what type of service you need, then critique the realtors on their skill set. Have they done the time? A realtor with a few years in the industry should have accumulated the experience to remain strong under pressure. Ask questions about the tough times that they have dealt with, and ask how long they've been in the industry as a realtor. Some realtors are too busy. A realtor with many clients is not always a good thing. It's an individual thing too. Some realtors cope better when they're on the run, very busy, or others provide a better service when they take your calls and then are managing their time with less work. The key here is to find a realtor with an optimum volume of clients, so they're happy to communicate you when you need them. Use a local realtor. Don't waste time with a realtor who's not working in the area you're buying in. We mentioned earlier the need for experience and knowing the area well is important. Select your realtor with a good track record in your area of interest. Verify that they not work alone, but as a team. It's good to work with a realtor that has a team, because you should make sure the first, if it fits for you, it should be understood up front that everyone is going in the same direction. Know how they communicate. You need to know how you and your realtor understand the type of communication you both prefer. Check if they can provide references, websites, past clients, reputation. Learn what they have to say. The best realtors are the ones who know how to listen and understand your situation. You will know their mindset and how they ask you questions and what things to tell you. My motto is the most successful transactions are the ones that build lifelong relationships. I pretty much every time I get very close with my clients, we become really good friends. And my references, I have 5-star reviews on every platform, on every review. This is a crime rate of Dallas-Fort Worth. This part's up so high because, well, that's the airport area. We can look at crime rates in neighborhoods. This is a soil map. You may not think it's super important, but we can kind of get a future forecast of if you're going to have foundation problems or not. I like niche. It'll tell you about schools, housing, jobs. It'll give a grade of that area. How are you guys feeling now? Are you excited, confident? or informed. Like I said earlier, this is going to be recorded and put onto YouTube just in case you didn't catch everything. If you guys want to put in the comments if you're excited or confident, or if there's something we could have done differently to make this a better experience. Remember to book a one-on-one consultation at toddpoorrealty.com/book, and book a time. We'll get you on the roadmap. We'll get you going. We'll save you money. Once you click on toddpoorrealty.com/book, you just click on the day you want and the time. They're probably filling up pretty fast right now. And we'll answer questions real quick. Well, Casey Cumbie is informed. What questions we have, Blake?
So Casey Cumbie actually said, I've learned that paying your credit cards and paying cars off is not good. They say you don't have enough open to track your payment and they can't go off what you paid off. Is there a way around this without having to open a big account? Okay, number one, pay your car off. I don't know who told you not to pay your car off, but pay it off. Because that is a monthly payment, and that actually can hurt you more than help you. When it comes to credit cards, let's get back to cars real quick. So when I'm reviewing credit, I look at your complete credit history. So even the cars you paid off, the student loans you paid off, it's all still on there. It doesn't necessarily drop off. So that's good to have that you paid that off on there, because and that does improve your score, because that shows that you paid each month on time in full, and that payment history is factored into your credit score. Now, when it comes to credit cards, keep them around 30%, under 30%. Just consider that your ceiling. So if you have a credit card with a max buying power of $3,000, don't ever spend more than $1,000 on there. So keeping some credit on there, yes, does help, but you don't have to have a huge amount. It's a 30%, and make your payments every single month. One of the biggest things on your credit is making payments. It's not how many trade lines you have, or how much you owe. We're looking at payment history. Banks want to know that you're going to make that payment. So paying credit cards and paying your cars off is actually really good, because it shows that you pay your loans off in a timely manner when you agreed to pay them off. Credit cards are called revolving debt. So every month you've got this payment, and just make that payment every single month. And it shows great payment history on there. Now, when it comes to having an amount of debt on that credit card, sometimes if you pay that credit card off, sometimes it's good to put $100 on there and have that credit there. But the trade lines that we look at for each payment that you have shows your history for that trade line, for that credit card, for that car, for that medical bill, for the student loans, stuff like that. So just make sure you're always making that monthly payment. Let's see, Angela.
We forgot to talk about, we do have a credit repair program. We have a service. It's usually $50 to $80 a month, and they go in and they target all your late payment history and work on getting all that removed off your history. Mm-hmm. So let me know if you're interested in credit repair too.
Yeah, they're really good about removing the collections and disputes. Absolutely. Those are considered derogatory trade lines. Let's see, transitioning to a new job for higher income wouldn't be helpful. Of course, that's definitely helpful. the point I was trying to make when transitioning a job, there's more work involved for you as the borrower, because people move to Texas because of their work. Their work brings them here. So there's not necessarily work history here in Texas, but there's work history, in Colorado, California, New York, Montana, wherever you're moving from. So transitioning to a new job with higher income, we would, if we're going to use that income, we would need the offer letter, and we would need to see it on your first pay stub. We would need at least that first pay stub to back that up. So it's not that it's not helpful. It just creates a little bit more work. Again, we can work with it. When will the new FICO 10T scoring go into effect? How will the new model affect approvals? So, I'm not sure when the new FICO 10T is going into effect. And from what I understand on that, and I need to dig it, I do need to read into that a little bit more. From what I understand, that's just a new way to get your credit score. So again, the score is going to the score is going to be essentially your risk as a borrower in numerical form. So it's a little bit easier to see for me to see, for banks to see what you're approved for. So the new model shouldn't affect approval because we still have that same score. The only way I can see that starting to differ is like score limits. If like, let's say, let's see, how do I put this? If like a 700 credit score under the new FICO 10T is equivalent to like a 600, well, now we're looking at different guidelines, and the guidelines would shift for that. But as far as I know, continue looking at credit like you do now. I think that's just going to be a new way to find the credit scores.
How do you sign up for the credit repair? Book a call and I'll get you connected.
Absolutely. Absolutely.
Here it is. And some people were wondering about Bank of America or NACA. If you are, give me a call. I'll help you get everything set up. We'll go look for houses, and you'll live a wonderful life in your house. Is there any more questions out there?
Is that it? Did we answer everything? That means we did a great job. That's what I'm taking that as. No questions. We did it. We informed everybody.
Okay, I'll give you
people approved.
I'll give you the option now to unmute yourself if you want to talk. Just click the microphone button if you want to talk to us.